Some critical areas were broken today. We've been going over these levels for some time, so we're going to jump right into it. Tonight's video is super technical. As always, subscribe to this channel if you want to follow along with what goes on during the week. Now, we've been talking about this upper channel line, and I'll refer to it that way, but rising wedges, they end in tears, and we talk about this all the time. You just don't know when, but here it is, and we can see that crack. We can always remember this July 17th date. Remember when the CTAs came out and they put that sell order out there? That was a critical juncture. We fought it for some time, had the test, the retest failed, and there's some other really significant things that are going on here as well. But the most important thing is this upper, and it's not perfect. You can actually, if you try to draw it perfect by cloning it, and we'll just clone it for a second, you'll see what I mean. If you come here, it's not perfect because you don't really fit anywhere whatsoever. So it's not really perfect, it's incongruent, which means that most channels, you really want them to be aligned. This one isn't really what you would have to do, and you can already say it, but let's just do it anyway. You're getting something more like this, and I really don't like those kinds of channels, but it's there. So what we're going to focus on more is this wedge and call this an upper wedge, and we can see the break from here. We can see the rejection. The question is, where does this go? So for what we're going to start with is clear it all off and do the simplest of things. And we're just going to drop in some moving averages and take a look at what's going on here. And what we're going to see is that we have the 22 and the 55. And then we're going to go out there and say, okay, when was the last time that we broke the 22 and the 55? And it's going to take us back to here in September. And it's also going to take us back here where we broke the 22 and the 55. Now, why is this significant? And I'm going to explain why it's significant to me. I'm going to take the 12 off for a second, and I'm going to take the 22 off for a second, just talk about the 50. So the 55 to me is, I use these as demarcation. You can do whatever you want with. For me, it's a demarcation line. So in this area, we have a battle, and that battle is being fought. And you have 3 to 5 days to figure out what's going to happen on that battle before a winner's declared. And that's usually what it is, 3 to 5 days. It's not an exact science, but it usually is 3 to 5 days. So if you can see in here, you're down 1, 2, 3, 4, 5, and then boom, you have some kind of event and it hits. And the reason for that is because the 55 is where institutions tend to fight. Now, people will say, I use the 50. My response is, you should use what you're comfortable with. I've found through 25 years of trading, some things work well that people use. Some things that I use tend to work better for me. Again, do what works for you. But if you see this level right in here, you can see that you had that battle. If we go to this battle as well, and we use our 3 to 5 again, okay, we break 1, 2, 3, 4, 5, okay, and you've made a decision, right? So this tends to happen. And I think it's because the yin and the yang of it, there's some kind of pull going on there during that 3 to 5 days, whatever it is. And then you see an event. Now, is that event the bottom? Is that event the top? I'm not saying that. But what I'm saying is there's usually some kind of event there. And it doesn't matter when you see it. If you stay below for longer than 5, you tend to stay below it for a period of time. If you get above it for more than 5, you tend to stay above it for more than 5, as you can see right here. So that's how I use the 55. I get asked that a lot in your comments, so please keep the comments coming. But to me, this is an institutional demarcation line, and that is how I use it, and that's how I'm going to continue to use it. And that's going to take us to the 22 real quick. Now, the 22 for me is really simple. Are the bulls in charge or are the bears? And that's really how I view it. And people will say, well, what does that mean? And what does that really mean to me, who's in charge? If you went and looked at your trading, and I always tell people, especially when they're new, to study their trading. When were your best swing trades? And I would argue that if you went and studied, your best long swing trades are when you're getting back above the 22. If you want to use a 20, you should use what you're comfortable with. But you can see your battle right in here again. Up, down, up, rejection, boom, breaks, up, over, breaks, 1, 2, 3, 4, boom, over, and here we are again. So when I break here, to me, the breaks go on, just like it did here, just like it does here, until I'm back over. I don't need to catch the bottom. I just need to be right and understand where the trend is. Remember, I'm what is referred to as a top-down trader. So I want the indexes aligned, I want the sectors aligned that I'm playing with, and I want the stocks aligned. When I have this, I'm very interested. When I don't have this, I'm not as interested. Are there times when I'll buy? Yeah, but usually it's not a lot, and I will be scaling in. It's a different kind of trade. I'd rather stick with my patterns. They work for me. And again, as people know, I also overlay what we refer to as the stool with the macro and the fundamental side, which we're going to go over with what happened to Apple tonight and what a dumpster fire that was, and why Amazon Amazon, I personally think, was really significantly well received, and we should go over some of that. It's important, especially after what happened with Microsoft. Then we think about this as a stool, and what we're really saying here with the stool is we sit on top of that, we trade, and then sometimes we lean on the macro, the fundamental, the technical. When I break here, my breaks are on. But this is telling me very clearly on the demarcation side that we are now, the bears are in charge. So when you do your swing trades long tomorrow, what you will find is they're not going to work as well. What tends to work better in this environment is short-term trading. And what we do with this is we just understand that, hey, this is what's going on right now. And we know why this is happening. I went over it in great detail last night. And the SMCI news is way more significant than people think it is. And we're going to address that again in some detail, not a lot. But if we just do the simplest of things again and look at this on a 5-minute chart and just took the pinpoints, nothing more, that's all you have to do. And you could say it, test, rallies, lower, breaks. Now, here's where this gets super interesting. And if you want to learn something and you want to watch a part of the video again and go, wow, that is really interesting. See how you tried to rally here? See how this bar encapsulated all these bodies? And what I said to everybody yesterday, if you go back and listen to yesterday's video, was that's a control bar. I know it doesn't look like a control bar, but it is. And if you go and take a look at it here on the SPY, it doesn't look that way. That's why even if you're trading the SPY, I always tell people to look at the ES. Even if you're trading the SPY, look at the ES because it's a more continuous pattern of what is happening globally. Same thing with the NQ. If you look at the NQ, I don't know why it always gives me that weird thing. You always look at the NQ and you see the same thing, right? You just go and take a look at the Qs. The same exact thing. You always look at NQ. It's just easier and it's more continuous and it just works. QQQ and the SPY, they're ETFs. They're not the index. I know that gets confusing to people, but it's not. So if you see this, what do you have? A rising wedge. How do they end? In tiers. And you can see we tried to rally, failed, the breakdown from here, all again against what level? And I always hammer these levels home to you guys so that you have demarcation lines. See, the thing about this is you don't want to tell the market what it's doing. You just want to trade what's happening. I should get a little moniker on trade what's happening. I think there's a way to do that. But if you take a look here, you can see that break, and from this date is what? CPI month over month negative. And then he's going to pull out that silly stool again and talk about macro, fundamental, and technical. Not going to do it to you right now, but you know it's out there. So when you're rallying and you're rejecting over and over again, getting rejected so many times, like me calling Giselle, then what happens? Finally, you just kind of give up, and here you are down in the dumps, and now you're going to have to move on with your life, aren't you? So here we are, the 12, the 22, and the what? The 55. So what is this telling me? Bulls or bears? Who's in charge? Bears are in charge right now. We still have institutional support. Are we going to continue to have institutional support after some of the debacles that happened tonight? Well, that's something that we should probably talk about. So let's get into a couple of those. There, in my opinion, are 3 or 4 major debacles. 2 started from last night, but before I get into those, let's cover what happened with Apple and Amazon and go from there. Now, if we take a look at Amazon, we can see that we've been in this range. And I'm showing this just set up like this to just explain something. When I look at moving averages, it's important to me that they don't look like an EKG chart. And what I mean is that there needs to be a trend. Moving averages without a trend are completely and utterly pointless. Okay, they are very difficult to read. You have to go to larger time frames if you're going to do it. It gets really very hard to look at these and say that they have value when you're trendless like this. And you really have been trendless, haven't you? But here's where we're at, and let's take a look at the big dogs for a second. And what we'll do is we'll get rid of the 22 and the 12, and we'll just leave the 55. And you can see how you would just get chewed up over and over again when you're trendless, right? All right, but here's earnings, and the last earnings, AWS, or their cloud-based business, was not going as great. I'm going to show you the whisper number on that right now, and we're going to go from there. But let's take a look at what's happening after hours. And there's a couple reasons for this that I want to show it. So I purposely showed how I do these trades after hours off of the VWAP. Now, this was a really good quarter, and then I just thought that the AWS number was a little low, and so I did do a really quick short. It didn't work. I closed it. Currently, I'm long the stock after hours. But see this right here? This is really all you need to see after hours. Holds, rallies, retests, goes. And then you have the call. You always want to watch how the stock acts when the call ended, and all it's done since then. You can actually look at this and see what bar the call ended on. Very important, guys. Always look at that bar, but look at it from a longer time frame. Something else you can do, and the reason I'm going over this, is because I got asked to point out more things that you could do after hours to say, is this a good idea? Is it not a good? Look at the volume. So after hours, we're trading about 600,000, 700,000 a bar every 15 minutes. That's not retail, guys. So you know that you have interest in the stock after hour on an institutional level. So that gives you some color on what's actually going on out there. Now, this was a pretty good report. And we did go over this on Saturday, talking about fundamental analysis and trying to get as much of an edge as you possibly can. And so here we are, Amazon buy-side bars. So in other words, buy-side would be institutions. What are they looking for to clear here to tell us that, hey, this is okay and this is something that we want to be involved with? Well, what they're telling us is AWS, the growth bar is 21 to 22%. With some hope for a small acceleration quarter over quarter, EBITDA bars didn't change, meaning earnings are the same on the buy side and the sell side. Sell side are institutions, Goldman Sachs, Morgan Stanley, JP Morgan. Buy side, guys like Greenlight or some other fund like Ackman that are out there that have their own analysts. Investors are still looking for 17 billion high end on the Q4 guide. 17 billion high end on the Q4 guide, 21, 22%. Let's see how we did. So if we go and dig into the number, what do we wind up getting? Sales, right up here, 16 to 20 billion, estimate 17.4, right? So, all right, so we now have the operating income to 16 to 20, and the estimate was 17. So that's where they came in. And we saw that number earlier, which is good. Then we would go through here and we just check the estimates very quickly, and we see that everything is coming in higher than expected. And that's always good. Third-party seller services are down a little bit, but the big dog that they're looking for is AWS. But if we go through subscriptions, they're higher. And again, across the board, everything is really coming in higher than expected. AWS, they were looking for 21, 22%. That's why I thought it might be a little weak because of what happened last night with Meta and Microsoft, talking specifically Microsoft just trashing the space. Kind of weird since they're in the space. But here we are, and you can see that estimate, and then you can see that they were down on that estimate, 19%. Now, they explained it very nicely on the call, talked about guidance, etc., and it went very well. And if we look just here at some other just key data very, very quickly, they break it down. Web services net sales, 19% versus 12 year over year. The estimate was 19.2. So you could say, all right, well, they're still in that range, and that's excellent. But is that this huge beat in AWS, which is their growth engine? And no, it's not. But you look at operating income, and this is like the exact opposite of what you'd want to see that we just saw from AMD. You're looking for 14.5 or 14.7, you come in at 17.4. So this is really where you want to see and what you're looking for. Operating margins are 11% versus 9.3. So this is pretty much firing at all cylinders. Where I was a little apprehensive was just on the AWS, and thankfully I was wrong because I'd much rather have them go up than down. We can see how the stock's responding after hours, and you're just hanging up at that level. After the conference call, there were just nothing but net buyers. So this would be the level that you'd want to watch, because you would understand that after that conference call, it's not retail making decisions, but institutions. We always want to know where they are. And if we just take the simplest things and look at the chart and go, oh, we're at 97 after hours, and realizing that that's going to put us near the top of the weekly high. So tomorrow, what area would we want to watch? Just right up here, right around that 200 level. Fast forward into Apple, and this is where it gets super interesting. If we take a look at my 100 levels here, I'm going to clean them off real quick. We're going to drop into a 1 minute and take a look at what happened after hours. And there's really only one word to say on what happened here, but you can see it right there when they spoke, and you can see the reversal. This is why I always tell people when they trade after hours, you have to be so careful because you have these moves to the downside, and then all of a sudden they just rip it up to catch, just catch anything that's out there. Or you put out your buy stops or whatever, and then they just ripped it right back. And this became very, very clear on what was going on. And this, they actually clarified it here, and it didn't go very well, but let's get to it. So if we take a look at Apple, okay, 94.9, right where they're supposed to be. Service, 24, missed on the service side. EPS versus 146 year over year. This is not great, guys. It's really not. Wearable home accessories are down. iPhone revenue was up, which was good, but this is what killed them right here. You're supposed to do 15.8 in China, and you're doing 15. That's a huge miss by them. iPad revenue is down, product revenue is up, but it's not going really well for them. And it's certainly not going well for them in the second greatest GDP in the world. China does not want the phones like they used to, and these numbers are way off. When you're off by $1 billion on a $15 billion number for revenues on your biggest selling product, it's a problem. Now, if we dive right into this, quarter revenues, the iPhone revenues, again, 5% year over year. It's not the growth engine that it once was, but they're chugging along. Mac revenue year over year, 1.7. They're not great numbers, guys. There's really, I wish there was a better way to say it, but even if you broke it down on the gross margin side, it's not really going to knock the cover off the ball. What I think is important is that, yes, everything's going in the right direction. What hurt us? And it's important to understand that because that's where the growth is coming from. And it was China, very simply. I would have to look this up, but year over year is actually down. And I don't remember the last time that year over year in China was actually down. And that would be something that I should look up because I'd be really curious about that, see if that is. I would imagine it might be despite something like the pandemic or the great financial crisis. It might be the first time that that's actually happened. It'd be really interesting. If someone knows the answer to that, put it in the comments. Now, again, I always mark off these bars and you just kind of watch them and go from there. For me, I will just drop a VWAP right there and you can just see where it's at. At the time of recording this, I do have a short position in Apple. But again, we'll see how this plays out tomorrow. It's very clear that they were very brutally honest about how things are going here. It worked it off into the call, which it tends to do. And then when the CFO starts to speak, that's it. So this is an area you're going to want to watch tomorrow, 225.43. The reason I'm giving you clean levels is because you asked. So I do read all the comments, so keep them coming. And please share these videos if you find value in them. It helps me greatly and get the word out and what it truly takes to be successful. So if you see these levels again, you're breaking the 55, which we would know if we close below the 55. What does that mean? We've lost institutional support. And if we lose institutional support, do we really want to be in the name until we get back over it? And some people will look at this and go, well, yeah, I mean, I wanted to buy it here because it worked. Yeah, that's great. But there are times when it's going to break and it's not going to come back. And so what you tend to do is I use these as demarcation lines. I'm not saying that I would not trade it for a couple dollars, but do I really want to be in when it's below the 55? Sure, maybe I can catch this for a couple dollars. Maybe it stays over, but when it doesn't, you need to respect your process. And this is where a lot of people get thrown off. They feel like telling the market what it's going to do instead of just very simply allowing it to do what it's going to do. One of the ones that struck me the most was Intel tonight and the amount of people that were just so dead set that this name was going to blow up. And they absolutely crushed. Take a look at this real quick. And I did get your request to start showing more live trades again, so I will start doing that well. But adjusted 12 versus 6. Gross margins 39.5 versus 38.7. You know, everybody wrote them off that they were dead. And I mean, everybody was pretty negative on this. Like it was just a pretty negative kind of feel. And then they just absolutely crushed. Adjusted gross margins 18% versus 45 year over year. Estimate was 38. Like it's not good, but I guess because it wasn't just an absolute dumpster fire that the stock's trading up. So it was actually a fun trade that we did after hours, but it is what it is. I'm not really sure that I would just hitch my wagon to this. You know, are you starting the bottom? You know, you watch that 55 and you are starting to get institutional support. So it is pretty interesting. Now I just want to go through a couple things here that I've reviewed on Saturday for you and show them live so you could say it. This is earnings when we pop up on Microsoft 443, and then you can start to see the break. And some of the techniques that I talk about are using anchored VWAP after hours on that bar to make more informed decisions. And you can see how it started to fade here into the 5 o'clock conference call. It's always important to know when the conference call is. So someone who is following this and using some of these processes, if they were uncomfortable and wanted to get out, let's say if it closed below the previous close, they could be out of this before the CFO comes out there and says, well, by the way, we're probably going to slow down a little bit on the CapEx because a lot of these chips that are being bought by VCs and they're not really doing anything with them. So what she did there, what they did there, I should just say, is just put themselves in a position where they're saying we're doing this, but we don't see the growth that everybody sees out there. Their strategy is a mess. Microsoft's strategy is a mess, and they really hooked themselves to OpenAI. OpenAI is probably going to turn out to be like the Bing of search engines. It's probably not going to be the standard, and we're starting to see that. I think it's why Apple walked away, and you can Google this. Even Microsoft's CEO knows he's in trouble, and he actually asked personally to have his own pay lowered if you want to look. So there's some real issues here, and I think that the idea was let's take everybody with us. I'm not really sure what the methodology was there, but it was not good. I've heard good before, and that's not it. Now, this actually was more troubling, and I'll explain why. This was a really solid quarter, and we went down. I bought this morning and had a really very nice, very quick trade with it, but it was really a game of hot potato, and I was kind of shocked at how fast it changed its tune, especially when it opens down. See, if they open up and then roll, you can usually kind of get a sense of that, right? But when you open down and then you take out that high of the open, you think you have a shot at it, but you can just say it. We're up, boom, bought right in here, traded it out, and then I wanted to be involved, and then it just didn't really work. Quite frankly, I made money, and I got out of the way. Broke right here, and then that was all she wrote all day long. But when you have something like this, that quite frankly, I don't see the holes in this quarter. He did not increase CapEx too much, not anywhere near what people were expecting. And earnings were solid, and he's showing that the AI model works, just like Google showed that it worked. But when we see stocks drop like this on news, you want to pay attention. It means negative sentiment. And it's really important to understand. You want to know where the sentiment of the market is. And we talked about going from extreme greed to fear before. And there's a couple things here I'm going to go over with you, but very quickly. But this was an excellent report. Stock's down $10 since. Okay? You have negative sentiment right now. Don't fight the tape. When you see this, do what's actually happening. And this is what I'm talking about, who's in charge, the bulls or the bears. Now, we talked about this last Saturday about how it's not that you're in greed that makes you sell or extreme greed, but it's dropping from extreme greed to greed that tells you that you're setting up to get into fear. This needs to be in the 25s or 26s in order to usually form a bottom. We're at 44, which probably means there's more pain on that train to come. Quick reminder, non-farm payrolls is tomorrow. Now, they are predicting a 1.6 or 1.7% move on non-farm payrolls. So you're going to want to watch the S&P and how it acts around 8:30. Remember, a hot number or higher number is not really what you want to see. It shows a weaker economy, but too low a number, and then that could spell that we're in a heated economy, and the chances of a rate cut next week are pretty much zilch. That's it.